Good evening, and thank you for joining me. This is Eric J, and I wanted to discuss a topic that I thought might be interesting to build on with regards to how redistribution occurs with regards to the banks. Now, I'm sure we have all heard of the FDIC and the NCUA. FDIC meaning the Federal Deposit Insurance Company, and NCUA, the National Credit Union Agency, or something like that. Now, these are all federal entities that are designed to ensure the deposits of the depositors, or at least that's the theory, up to at least 250,000. What it really does is that it's a hedge for banks against the banks going down, so that the banks themselves will be able to pull against federal insurance so as to ensure that depositors have their deposits guaranteed. So really, it's kind of like a hedge for banks against their own failure. But really, that's utilizing taxpayer money as a redistribution to prop them up in their own failing policies. So one thing I always try to do is I always try to look for free market answers as a counter to any kind of government style of intervention or assistance. So here's my thoughts. Instead of relying on the federal government to federally insure our deposits, well, we already have insurance companies out there, Geico, AAA, Aflac, or what have you, that provide home insurance, car insurance, medical insurance, dental insurance, what have you. And none of these are actual public agencies, which means that we don't actually need the government to protect or to back our property, meaning even our money in this case, since we already have private agencies who already offer those services to us without actually needing to take it out of our paycheck to prop up a possibly failing agency. So here's my thinking is, instead of the federal government doing it, you enable these different insurance companies the chance to offer insurance vehicles or products which are being offered not to the banks, more to the depositors themselves, you and me, the customers. So, and instead of saying, oh, well, your deposit is insured to 250,000, then you can go ahead and say, well, I don't have that much money inside my savings. There's no point in me paying the money it would take just to hedge my own deposits up against that much. So how about I pay for a $5,000 policy, or even a $20,000, something just to hedge my deposits, my savings, my checking up to a certain degree, much closer to how much you can currently already pay, which means that all of a sudden these insurance companies will be able to offer something far more customized to the individual clients, to the individual customer, you and me, everyday Joe or Jane, who want to be able to protect their assets without having to worry about having it taken out of our paycheck through income tax. Now, this offers another interesting perspective, because just like any teenager who's buying insurance to cover himself while he's driving his car, there's a certain level of risk that an insurance company is hedging against for their customer. So in this case, you have banks who say that the whole too big to fail thing comes up again. You would now have these insurance companies who have a vested interest to look at the financial portfolio of your bank and say, well, you're banking with this bank, and their debts to asset ratio, their liabilities, or what have you, make them a higher risk for failure. So while you're banking with them, we're going to charge you a higher rate on a monthly premium to be able to cover your $5,000, $10,000, $20,000, $30,000, what have you, upwards of however much the insurance company is willing to cover. And so all of a sudden, now you have a vested interest. Actually, these banks would have a vested interest to look at their loans to asset ratios and think, well, we're going to start hemorrhaging clients, hemorrhaging customers, because now all of a sudden they are paying for these relatively inexpensive insurance policies, but their premiums are going higher only because they're banking with us. And it provides a bit of an interesting scenario where now the banks have to fight harder to maintain a more stable business plan in order to retain their customers, retain their clients. For those clients who want to keep their deposits as long as possible stable, so that whenever they file a claim with their insurance company, to have the amount of money that they had insured paid back to them, that the premium is as low as possible, that they have to pay out to the insurance company, and the insurance company could take a look at the bank that they're with and say, you know what, their risk level is much lower, and then go from there. Now, this risk issue would then have to go on to the consideration of the FDIC and the NCUA, this hedge that they are there. And so long as those exist, there's no incentive for the banks to improve, because they're always going to have that hedge with them. So having these insurance companies provide a protection to the customer now puts it toward the customer to go ahead and then tell the federal government, you know, we don't want to have the FDIC and the NCUA anymore. We already have our own private company who's insuring our individual deposits. And so we want you to get rid of this hedge, so banks have far more of a reason to improve upon their business plan, not make too many loans, keep more money in their fractional reserve ratios so that their reserves are much higher in case the customers go ahead and then try to withdraw money. There won't be so much of an issue of a run. Now, that being said, that's not stopping any insurance company from also offering those same kind of insurance products to banks. So banks could simply say, instead of trying to receive money from the taxpayer, they're now paying individual insurance companies to cover their losses in that case, so they could be putting up something like covering 10 million, 20 million, 30 million, 100 million, a billion, 2 billion, however much the insurance company is willing to cover. However, that's their prerogative. But I felt this was a far better, inexpensive hedge of protection for the customer, instead of just having to rely on asking for their next door neighbor or what have you, or their friends and family, to cover their losses in the form of federally paid for insurance, to then have it to where they are now directly investing in the protection of their own assets through their insurance products. Well, anyways, it was just an idea, and I'd welcome your input on this. Thank you very much, and have a good evening.
Also, should it pique your interest, for the enterprising mind, below is a link to the Tom Woods Liberty Classroom, where you can really expand your knowledge of free market economics, which is the same school of thought that great thinkers such as Milton Friedman as well as Murray Rothbard really championed. So go ahead and take a look at it through that link, as well as for those fans of Ron Paul, go ahead and check out his homeschool curriculum, also below in the description box. Thank you for joining us this evening with our discussion. Please do yourself a favor, hit that subscribe button so you don't miss any of the additional uploads that I make. Please remember to share with your friends and family so they can also join in and contribute to the discussion about our government and our founding documents. Also, do yourself a favor and check out the other videos on my channel so we can continue the discussion even with them. God bless and good evening.